And we are going to get going. Hello again, everybody. We are in chapter 11, maximizing our profits. So this chapter is really interesting because it really speaks to the business owner. It speaks to the person who is looking to do something with their business or who is looking to make money, period. You know, if I make something and it costs a certain amount of money and I sell it for a certain amount of money, will I make a profit? And that's always the question. It doesn't really take into account any of the other resources, though, like employees, etc. But it is helpful and a place where we can start so you can grasp the concept of how to maximize profits. In addition to that, when we're looking through and when we're doing very simplistic things, like say you have a kiddo and they have a lemonade stand and, hey, mom and dad, how much should I sell this lemonade for? Well, if you want to make money, you have to sell it for this price. And if, you know, you just want to have fun and break even, then you sell it for this price, you know, and most of the time you'd have to sell the whole lemonade in order to get your money back, or the whole pitcher, I should say. All right, but let's talk about it. I'm going to share my screen with you guys in just a second here. It's going to go ahead and it is going to share. And we're going to look at it in terms of maximizing profits. Okay, so let's go to your slideshow. I always like to make a slideshow and have you guys see the actual slideshow. So chapter 11, maximizing profits. Hopefully you already read it. After reading the chapter, we're going to look at measures of profitability, describe how to increase profits, how to maximize them, and discuss how for-profit and not-for-profit providers differ. So let's first define profitability. Profitability is the following: revenue minus cost. That's your profit. Revenue minus your cost. So for example, you know, you're selling lemonade and you made $10, right? And we're thinking little kids lemonade stand, right? And you spent $10. I'm sorry, you made $10 in revenue. But your cost to make the lemonade, to buy the plastic cups, etc., was $11. Well, you'd have a negative $1 in profit, meaning you didn't make any money, you lost $1, right? You didn't sell it for enough, whatever you were selling it for. So profit is revenue minus cost, and your profit, you know, always has to be, or should always be, I should say, in the green, because if it's in the red, it means you lost money, right? So your revenue should always be more than your costs. So both revenue and cost are accounting principles and constructs, and they need not correspond to cash flow. And we'll talk about that a little bit as we move on. And we'll also talk about return on investment, right? So if you invest in something, you want to make sure you actually make money. That's what we're looking for. Okay, but to drive this home, let's see a very short video about it. And I think it's actually, hold on, it's right here someplace. Oops. I know I pulled it over. Here we go. This is right here. Here we go. I forgot where I put it for a second.
Operating profit, also known as operating income, is a measure of a company's efficiency. It is the profit generated from the core business of a company before accounting for interest and taxes. In accounting terminology, operating profit is known as earnings before interest and taxes, EBIT. The operating profit for a business like Giacomo's Pizza is going to be the pre-tax profit generated from selling pizzas, which is the core business of the company. Remember, earnings not directly related to the core business operations are not included when calculating operating profit. The earnings that will be left out of the calculation are income from companies' investments, capital gains on asset sales, rental income, bank account interest, miscellaneous earnings like fees, dividends, and so on. Operating profit is calculated as operating profit equal operating revenue minus cost of goods sold, COGS, minus operating expenses minus depreciation. Here, operating revenue is the income from the company's core business operations. COGS, or cost of goods sold, is the cost incurred in manufacturing and selling the company's products. Operating expenses include expenses related to sales, marketing, R&D, administration, restructuring, etc. Depreciation accounts for the decrease in the value of the assets over time. Consider the income statement of Giacomo's Pizza. Giacomo's Pizza Limited. Revenue, $2 million. Interest earned in bank accounts, $80,000. Earning from 30% stake in Yes Beverages Limited, $1 million. Costs of goods sold, COGS, $1 million. Labor, $400,000. General and administrative expenses, $50,000. Based on the information, the operating profit for Giacomo's Pizza will be operating profit equal $2 million minus $1 million minus $400,000 minus $50,000 equal $550,000. The sum of $80,000 and $1 million is not included because it is income from investments, not from selling pizzas. Operating profit helps to gauge the health of a company's core business and is one of the important factors to consider when an investor is looking to pick the company's stock. Using such measures for comparison makes the most sense when comparing companies within the same industry. If a company is experiencing a decline in its operating profit, this reflects that there is less money for future expansion, paying off the debt burden, etc. Operating profit shows the profits from a company's core business that are not diluted with income from any other source, and thus reveals a lot about the profit-generating capacity of the management.
Alrighty. That was great. Okay, and again, why is that important? Well, it's important because we need to know, are we making money? Are we losing money? Where are we at? So the gross profit is the total revenue minus the expenses directly related to the production of goods for sale, and that's called COGS, or cost of goods sold. Oh, excuse me, I have to sneeze. I think. There it was. I had to sneeze. Derived from gross profit, operating profit reflects the residual income that remains after accounting for the cost of doing business. Okay, so your operating costs, or I'm sorry, your operating revenue, operating profit, I'm sorry, that sneeze got me all thrown off, has to do with how much you're actually making after those expenses. Okay. So we watched that one. Now we're going to go back to defining profitability. And again, we're doing this in a very simple way. So we're not even looking at that yet. We're just looking at profit. Profit equals revenue minus costs, right? So both revenue and costs are accounting constructs. So a profitable organization might have cash flow problems and might not be earning an adequate return on investment. So that's something that you have to remember. And return on investment means, how much are you getting back once you, have all of your things taken into consideration. And we'll look at it as we go through with examples. But unprofitable organizations are more likely to have those problems. So what it's saying is, whether you're profitable or not profitable, you could have cash flow problems and you may not be earning enough return on investment. So a profitable investment with potential cash flow problems, right? So what this shows you is year zero, you're not making any money. And anybody will tell you when you open a business for the first 1 to 5 years, a lot of people don't make any money at all. And you're like, well, that stinks. What do you mean I don't make any money? Well, sometimes you're putting out a lot of money in marketing or you're hiring employees and you're just not making any money. You just didn't make any money. So for example, year zero, revenue is zero, expense is $1 million, and that might be to start it up or who knows what it's for. So your cash flow is in red here, right? And that's always bad. That means that you're in the negative, right? So you have a negative $1 million. In year one, though, you made $500,000. Your expense was only $100,000, right? So your cash flow then was $400,000. So you spent $100,000 in expenses, but you took in $500,000. So $500,000 minus $100,000 equals $400,000, and it's black because you made that money. Okay, so that's good. So the first year you lost money, the second year you made money. Year two, you also made money, same amount you made in year one. In year three, you made money. And in year four, you made money. Okay. So what does this tell us about this investment? It tells us that this is a profitable investment. But unless the cash flow problem is addressed, the company might fail before it would recoup what it originally put out, right? And that's part of the issue, because originally, we had a negative $1 million in cash flow. Can't forget about that. So revenue is $1 million, cost is 800. And here's where we're gonna just give you a good example. So the revenue is $1 million and the cost is $800,000, and it breaks it down. Labor was $400,000, supplies were $300,000. The facility itself is $100,000 for the year. So 4 plus 3 plus 1 is 8, right? So your revenue is $1 million, your cost is 800,000. What's the profit? So you do 1 million minus 800,000, right? So what's 1 million minus 800,000? That's $200,000. So both revenue and costs are what we're looking at here. Okay. So the profit equals $1 million minus $800,000, which again is $200,000, right? So your profit is $200,000. The second bullet point here says that the facility is worth $400,000 in another use. So the accounting cost does not equal the opportunity cost. It does not generate economic profits. The facility is worth $400,000 in another use. Okay, so when we're looking at profits, when we are looking at opportunity costs, and again, an opportunity cost, in case we forgot, just basically means that there was an additional cost, and it could have been a financial cost, it could have been a time cost, there's some other cost that was introduced there. Substantial numbers of healthcare managers serve firms that want to maximize our profits, right? So for example, for-profit hospitals, most insurance companies, most doctors, they want to maximize their profits, right? Because you have to be in the black, not the red, in order to keep your business going. So recognizing that with no margin, there is no mission, many not-for-profit healthcare organizations act like profit maximizing firms. And what does that mean? If you were confused when you read that in your textbook, it means that if you can't bring home enough money to pay your employees and to keep your business going, right, then that's it. You close your doors. There's no mission. There's nothing to support. You will close. You will not remain open. So not-for-profit healthcare organizations need to act like for-profit firms. They need to make money. They need to be competitive, etc. So even organizations that are not exclusively focused on the bottom line have to balance financial goals with everything else that they're doing. If you're bankrupt, if you go bankrupt, if you close your doors, then you failed. You didn't accomplish anything. So healthcare managers with objectives other than maximizing profits have to understand how to maximize profits. You can't just be so focused on efficiency or so focused on customer satisfaction or whatever the case may be that you're not trying to maximize profits. Because if you're not maximizing your profits, if you're not making money, then you have to close your doors and it's game over, right? So a manager who does not understand the opportunity costs, right, in the terms of like what they're missing out on in profits, that can be a very, very bad thing. So us as healthcare managers need to understand how to maximize profits. We have to understand competition. We have to understand the differences between for-profit and not-for-profit firms. In finance, when you're talking about making money, both need to make money. So they're not that much different, right? Profits are the difference between total revenue. Again, let's go back one. Okay, again, profits are the difference between total revenue and total cost. So to maximize those, you must identify the strategy that makes this difference the largest, right? In other words, identify the product price or the quantity for that product and the characteristics that maximize it. You have to maximize your profit. Even if you're not for profit, you still need to make money. Okay, so that brings us to gross profit ratio. Revenue minus the cost of products sold divided by revenue. So, and ROE, for example, or for your knowledge, I should say, just in case you didn't know, is return on equity. And then ROI is return on investment, right? So we're going to talk about those as we continue. But I have a nice little video for this one too, before we get started. And I love these little videos because they really do some great stuff here.
How to calculate gross profit. One of the most important financial concepts in running a business is the computation of gross profit. The gross profit on a product is computed as sales minus cost of goods sold equals gross profit. To understand gross profit, it is important to distinguish between variable and fixed costs. Variable costs are those that change based on the amount of product being made. These include materials used, direct labor, packaging, freight, and depreciation on equipment. Fixed costs are more static in nature. They include office expenses, salaries and wages of office staff, including taxes and benefits, advertising and other sales expenses, insurance, and rent. While gross profit is a dollar amount, the gross profit margin is expressed as a percentage. It's equally important to track it, since it allows you to keep an eye on profitability trends. This is critical. Many businesses get into trouble with an increasing gross profit and a declining gross profit margin. The gross profit margin is computed as gross profit divided by sales equals gross profit margin. There are two key ways for you to improve your gross margin. You can increase your prices, or you can decrease the costs to produce your goods. An increase in prices can cause sales to drop, and if sales drop too far, you may not generate enough gross profit to cover operating expenses. The second method of increasing gross profit margin to lower the costs to produce your product can be accomplished by decreasing material costs or increasing efficiency. Whether you are starting a manufacturing, wholesaling, retailing, or service business, you should always be on the lookout for ways to deliver your product or service more efficiently. Just be sure to balance efficiency and quality to ensure that they don't get out of balance. Let's look at the gross profit of ABC Clothing Incorporated as an example of the computation of gross profit margin. In year one, the sales were $1 million and the gross profit was $250,000, resulting in a gross profit margin of 25%, $250,000 divided by 1 million. In year two, sales were $1.5 million and the gross profit was $450,000, resulting in a gross profit margin of 30%, $450,000 divided by 1.5 million. It is apparent that ABC Clothing earned not only more gross profit dollars in year two, but also a higher gross profit margin. The company either raised prices, lowered costs, or found a way to produce its clothing more efficiently. ABC Clothing did a better job in year two of managing its markup on the clothing products they manufactured. Many business owners get confused when relating markup to gross profit margin because both deal with the same variables. The difference is that the gross profit margin is figured as a percentage of the selling price, while markup is figured as a percentage of the seller's cost. Markup is computed as selling price minus cost to produce divided by cost to produce equals markup percentage. Computing the markup on individual jobs will affect your business going forward and can often make the difference in running a profitable operation.
Okay, great. So that was how to calculate gross profit. And it also added in a few additional things that we don't really need right now. Excuse me. But all great news, or all great information, I should say. So gross profit ratio, right? Revenue minus cost of products sold divided by revenue. And we also have return on investment, or I'm sorry, return on equity and return on investment down here. Okay. All of these are efforts to make reported profits more meaningful, right? So earning $50,000 is impressive on revenues of $100,000, but not if you were going to, have a revenue of 10 million, right? So if you were making had a revenue of 10 million, but you only earned 50,000, that wouldn't be very good. Similarly, realizing $5,000 is fine on an investment of $25,000, but not on $250,000. So that's why we do this, in order to see what's going on here. So return on equity. Profit and equity here. Profit divided by equity. Equity equals the value of the owner's investment. Return on investment, profit divided by investment, and that's specific to a project or investment. Profitability is important. Oh gosh, and again, why is profitability important? If profitability wasn't a factor, then you really wouldn't have to worry about making money. If money wasn't a thing. Like, let's say you run some kind of business and you're independently wealthy, so you don't care if it makes money or not. If it loses money one year, you're not worried about it. Well, that's great for you, right? But that's not how it works. So for-profit and not-for-profit firms alike, and these are just abbreviations, so don't get lost on that. I know people say, what the heck is FP and NFP? FP is for-profit and NFP is not-for-profit. And typically what I usually do is pull this out and make sure that I have, I usually put it in parentheses, but I forgot to do that. So let me do that for you here. For-profit. I'm sure you guys could figure that out, but not for-profit. Just in case, I like to have it on there. Okay, so profitability again is important. It's just as important for for-profit as it is not for profit. So Sister Irene Cross of the Daughters of Charity had said, again, and it's in your textbook, no margin, no mission, meaning if we can't make money, if we can't sustain ourselves, if we can't make enough to keep this business running, then that's the end of our mission. We're done. We're cut. It's over. Unprofitable firms are slowly going out of business because you just can't keep it if it's not profitable. So what your for-profit or not-for-profit firm should do is important. So what should they do? They should be profit maximizing. They should maximize their profit. Firms that do not do that fail, they waste resources, and they're just not producing what people want. And if you're not giving the people what they want, you're not giving them anything. So how do we maximize profits? What should we start and stop doing? To maximize profits, we need to increase efficiency, shed unprofitable contracts, which just means, cut off communication with any business venture that we're not making money on. Add profitable contracts, close unprofitable business lines, open profitable business lines, and price to increase profits. Okay, so if you're selling, let's say that you're making something, and it doesn't matter what you're making. You could be making lunch pails, right? So you're making lunch pails, and the lunch pails cost you $1 to make, and you're selling them for $1.25. Well, that's a problem because you're only making 25 cents per lunch pail. And I can guarantee you that you have to have some kind of manufacturing process and that your operating cost is going to suck up all that profit, right? So you're not really going to have any profit. So price to increase profit. So if it takes you $1 to make a lunch pail and you're trying to sell it to make money, right? You would need to price it probably at $10.99, $12.99, $14.99, something like that, so you make enough money. Increasing efficiency is an essential part of profit maximization. So if you're not being efficient, you're wasting resources, time, energy, money. You guys know it. You go to the grocery store, if you go without a list, you're going to walk around aimlessly for a little while trying to remember what you needed. But if you go with a list, you can hit up every single aisle that you need, and it'll go much, much quicker. It's kind of the difference. I always laugh with my husband. I say it's the difference between me going to the grocery store and you going to the grocery store. I go to the grocery store, I already have it in my head, what I need and what aisle it's in, if not written down, and where to go to get it. So I can zoom in and zoom out. But if you go in thinking, I don't really know what I want and I'm hungry, you'll walk up and down every single aisle. You'll leave with a whole bunch of crap you don't need or want or, whatever. You'll buy duplicates of stuff that you already have at home, right? So you guys know how efficiency works. So again, an essential part of profit maximization is making sure that we have efficiency, okay? Cost reductions can be very profitable, and high-cost producers struggle. So let's say that it takes you $10 to manufacture a lunch pail or a lunch box, and it takes me $1. And you say, oh, well, my lunch pail is so much better than everyone else's lunch pail. It's biodegradable in 15 years or whatever the case may be, whatever makes it wonderful. If it takes $10 for you to make your lunch pail and everyone else is making lunch pails for $1, that makes you a high cost producer, and that's a problem. So neither easy nor fun. It involves firing workers, even the ones who didn't do anything wrong, because you're trying to increase efficiency. But inefficient firms often fail. So again, if you're inefficient, it causes people to lose their jobs, customers to lose a supplier, stakeholders to lose their investments. It's a disaster. So what's one way that we can increase profits? And you heard it in the video. We can cut costs, right? So let's say revenue was $3,000. The 4% cut was $3,000. And then the 7% cut was $3,000, right? So let's look at this. So the cost, $3,100, right? So the revenue was $3,000. The cost was $3,100. The profit then, what's $3,100 minus $3,000? It's a negative $100, which is why it's in red, right? Negative $100. So the margin was negative 3.3%. So in this, you realize that you have to cut your costs, right? Because your revenue is probably going to stay the same, but you have to cut your costs. So if we know that we lost money by a margin of 3.3%, right? Let's do a 4% cut. A 4% cut in our cost. So 3,100 at 4% would be 2,976. Now we have a $24 profit because 2,976 and 3,000 equals $24, right? And then our margin is 0.8%. Not great, but it's better than it was. At a 7% cost cut, we go from 3,100 to 2,883, and then we see a $117 profit, and now we're at a 3.9% margin. So as you can see, all this means, and this is really fancy, and there's, it looks like a chart and it's fancy, but all we did was we cut the cost. We cut it by 4% and then we cut it by 7% in order to make money. So again, all firms need to maximize their profit. So we expand our business only if our marginal revenue is greater than or equal to our marginal costs. Stay in a line of business only if profits are adequate. Adequate. Meaning, we're not totally losing out. So marginal revenue. Change in revenue divided by change in output. It can be positive or negative. And our marginal cost is the change in cost divided by the change in output. And that is always positive. Always positive. Now, in case you guys were reading this and you were looking into it and you're like, this isn't as clear as I would have liked it to be. It's not very difficult. Just think of it like this. Marginal revenue is a central concept in economics, microeconomics to be specific, that describes the additional total revenue that's generated by increasing the product sales, typically by 1 unit. Okay. So it's the increase in revenue that results from the sale of 1 additional unit of output. All right, so just think of it that way. It makes it much easier. And then marginal costs, you're going to want to do the same exact thing. Don't make it more difficult than it is, because that's easy to do. Marginal cost is the cost added by producing 1 additional unit of product or service. Okay, 1 additional unit. So what's an example for marginal cost? Let's say it takes $10 to make 10 cups of tea. So to make 1 more, it would cost you 80 cents. So then the marginal cost, which is the additional cost to produce 1 extra unit of output, includes both your fixed and your variable costs, right? So you're basically just breaking it down and you're saying, here's what it would take. Here's what it would take. And this helps businesses maximize their profit, of course. And we'll talk a little bit more about why in just a second. But just to make that kind of clear for you guys, marginal cost equals the change in total cost over the change in output or quantity. Okay, and here's another example. So we have marginal revenue, and again, I like to put that in there, is change in revenue divided by change in volume or change in quantity, however you want to think about that. So in this first line, you see the price was $200. We didn't sell anything. We didn't make anything. So the marginal revenue was nothing. There was nothing to have. In your second line, the price was $160. We sold 800 units. We made $128,000. So the marginal revenue then was $160. If you're asking yourself, how did she get $160 out of that? I'm going to pull over my calculator and show you. So 800 divided by, oops, actually that's not going to work out. 128,000 divided by 800 equals, oops. Sorry guys, 800 divided by 128,000. Hold on, I keep doing something wrong here. There we go. Sorry about that. I kept typing in the wrong number. That wasn't helpful. 128,000, I think I forgot a zero a couple times, divided by 800, right? So the change in revenue, 128,000 divided by the change in volume, 800, 128 divided by 800 equals 160 in marginal revenue. All right, good. Now, what we have to do is take, and I'm gonna move my calculator over so you can see this down here. To get this marginal revenue, we need to do the change in revenue, okay? So this time we have to subtract 192 minus, which is right here, minus 128, because that's the change in revenue, right? That's the difference between the two, equals 64,000, right? 64,000. I should probably put that down here, because we skipped that step. 64,000 divided by, and then you're going to do 1,600 minus 800. That's the change in quantity. 1,600 minus 800. That's the change in quantity, which gives you 800. Oops, let me move this over a little bit. It's not giving me a whole lot of playroom here. So 6,400 divided by 800, or I'm sorry, 64,000 divided by 800 equals $80. So in this first line, there was no quantity sold, there was no revenue, so there was no MR. In the next line, we had 800 units sold. We had a revenue of $128,000, right? So change in revenue divided by change in volume. So for this year, whatever this was, we took 128,000 and divided it by 800 and got 160. In this third year, right, we had to find out first what the change in revenue and change in volume was. And we did that by subtracting. We subtracted 192 minus 128, 1,600 minus 800, and then divided those two answers, 64,000 divided by 800, and that equals 80. So our marginal revenue was $80. Okay. Perfect. Alrighty. So for-profit supply. Now, do we know if we could expand? And that's the question. We could expand as long as our marginal revenue is greater than our costs, our marginal costs, right? And this is the greater than sign, which I wrote out, just in case you forgot. So what does that mean? It means our revenue has to be bigger than our costs, better than our costs. So our revenue has to be $1 million, the cost has to be $500,000 or something like that, right? You can't have the revenue be $1 million and the cost be $2 million, because then you lost money, right? So it's just really common sense here. Be sure that your price is greater than your average total cost, right? Your price is greater than your average total cost, meaning that you're pricing it higher than what it costs to make it. Maximum profits may be negative. So if you have negative profits, here's what to do. Okay, for-profit and not-for-profit firms. Do any healthcare firms try to maximize profits? Yes, they all do. They all do. The ones that are for-profit, not-for-profit, they all do. Not-for-profit supply may differ from for-profit supply for 3 reasons. They have different goals. They have lower costs due to their not-for-profit status. Don't forget, the only difference between for-profit and not-for-profit is that not-for-profit are tax exempt in a lot of areas. A more severe agency problem, multiple goals, ownership impossible for managers. All firms have an agency problem. Okay. The not-for-profit supply, MR plus MB equals MC. MR plus MB equals MC. Now, what does this mean, right? What does this mean? So when we're talking about not-for-profit and for-profit, and again, I want you to remember that our for-profit and not-for-profit are really kind of the same when it comes to having to make money, right? We all have to make money. We can't not make money. If you're not making money, then you're not moving forward. It's a disaster. You have to make money, right? You have to make money. You can't not make money. So remembering that you must make money, and we didn't cover MB yet. This is marginal, benefit. I'm having some kind of allergy thing going on, and it's really terrible. So I apologize. Oh, I think it's done now. Oh, I don't know though. All right, I'm just going to add this while I'm thinking about sneezing. Oh, okay, I think it passed. Although you never do know. Okay. All right, I'll add this too while I'm at it. I don't know if anyone else is having some extra issues here with allergy season, but it's really getting me this year. All right, let's do this. Let's make this smaller because it's all over the place. Make this smaller because it's all over the place. And we'll make this smaller because it's all over the place. I hear other people sneezing outside. I guess it's not just me. Okay. All right, let's move this down. All right. Probably should have did that before, but I didn't realize that I didn't fill that in. Okay, so not-for-profit supply. Marginal revenue plus marginal benefit equals marginal costs. So the marginal benefit, if the marginal benefit is greater than 0, produce more than a for-profit. If the marginal benefit equals 0, produce as much as a for-profit. If the marginal benefit is less than 0, produce less than a for-profit. So the marginal cost may differ for not-for-profits. We don't observe, again, the MB or the marginal benefit. Marginal benefit may depend upon other income. So struggling not-for-profit may act like a for-profit, and what does this all mean? It means that you need to make money. So, it's not like not-for-profits don't fire people. If you aren't making any money and you have to fire someone because, we're just spending too much money in payroll, then that's what's going to happen. Cost reductions often require improvements in clinical management because differences in costs are primarily driven by differences in resource use, but not differences in cost per unit of resource. So an organization cannot maximize profit if it overpays for the resources that it uses. Like, for example, if it overpays the people who work in it, right? You can't pay someone $100,000 a year if it's causing you to lose money, right? So that's a problem. You as a manager are going to be responsible for ensuring that the interests of the individual doctors are aligned with the organization or with the changing environment. So for example, physicians or doctors usually benefit from changes in clinical processes that improve quality of care or make care more attractive to patients. So again, it really does matter that we are being efficient, that we are trying to make sure that we understand that we need to make money. It doesn't matter if you're in a for-profit or not-for-profit. Okay. So choosing contracts that maximize profits. So knowing how to maximize profits is vital, even if it's not a priority, right? should you sign this contract? And we're going to go straight to the example because I think this is really great and it's easy for you guys to see. So in contract 1, volume 2,000 units, 2,000 people, whatever you want to call it. Revenue is $200,000 and the cost is $150,000. So what do you guys think? What's going on here, right? You're earning $50,000 on sales of $200,000, which is a robust margin of 25%. So should we sign? Yes, we should. Yes, we should. You're making a decent amount of money. All right, let's look at these two contracts. Contract 1, volume 2,000, revenue 200, cost 150. Contract number 2, volume 3,000, revenue 300,000, cost 270. 270. So what do we notice here? For contract 2, the revenue increases by $100,000, right? But costs increase by what's 270 minus 150, $140,000, right? So your marginal revenue is less than your marginal cost. And what's that going to do? Your profits will fall. It'll cause your profits to fall. So although it looks like, you know, we're making more money here and this is great, we're spending too much. Okay. So in conclusion, why do we increase profits? For efficiency, for making deals if the revenue is going to be greater than the cost. We do it to reduce price. We do it to increase volume. We do it to make sure we make money. We do it to make sure that we have the volume and the price and the people and that everybody wants to show up. Not-for-profit organizations are sometimes different from for-profits, but not always because they have to be profitable. You cannot run a business in the negative. You cannot run a business in the negative, in the red, right? It's just not going to work. It's not going to work. All right, guys, that was chapter 11. We are going to move forward. We're going to take a break. Then we are going to move forward. We're going to do our breakout session, our breakout groups, and we're going to talk about chapter 12. All right, have a great break. I'll see you back in a couple.